On Holding is currently trading at $41.87, up about 0.87% on the day. The stock has been volatile, opening higher at $42.29 and hitting a high of $44.73 earlier in the session before pulling back to this current level, which is much closer to its intraday low of $41.52. While most of the financial media is just catching up to the massive 25% jump On Holding posted yesterday after its stellar Q3 earnings, what they're missing in today's price action is the battle between profit takers and new money. Yesterday's surge was a short squeeze and an explosive re-rating, but today's movement, on very high volume already at 7.5 million shares, shows a market in deep negotiation. The expectation was that yesterday's earnings blowout would just keep running. The reality is that at these new, higher valuations, a contingent of traders is cashing out, while long-term bulls are trying to establish a new support level above $40. This isn't just a rally anymore. It's the difficult process of building a new base. The general belief, the expectation for On Holding has been crystal clear for 2 years. This is the next great growth story in apparel. It's the Swiss-engineered rocket ship, a blend of Tesla stock's disruptive energy and Apple stock's premium brand mastery, but for your feet. You see the unique cloud soles everywhere, from marathon starting lines to airport security. The narrative is that this company, backed by tennis legend Roger Federer, is in the early innings of stealing massive market share from legacy giants like Nike and Adidas. The stock has become a favorite for those involved in online investing, a core holding for many looking to invest online and capture that next big consumer trend. But that narrative, as clean as it is, obscures the much more complex reality. The reality is that On Holding is now entering a new, far more difficult phase. The Q3 earnings we just saw were, without a doubt, spectacular. Net sales up nearly 25%, 34.5% on a constant currency basis, to CHF 794.4 million, absolutely crushing estimates. Gross profit margin hit a record 65.7%, a 510 basis points improvement. This is what you get from a focus on the direct-to-consumer (DTC) channel, which itself grew 37.5%. And net income exploded by 290% to 118.9 million CHF. These numbers are phenomenal. But here's the tension. This success is now forcing the market to price the company not as an underdog, but as a genuine contender. And as a contender, it now faces the headwinds of that success. The stock trades at a very high price-to-earnings ratio, around 50 times TTM earnings, even after this massive profit surge. This valuation demands absolute perfection. Let's look at the immediate technical picture. The stock just gapped up from the $35 level and cleared a major resistance area around $40 to $41. Today's battle is about holding that breakout. Traders using platforms like interactive brokers, which are built for this kind of technical analysis, are watching this $41.50 level intently. If it holds, it becomes new support, and the next target is the $44.73 high of day, followed by a push toward the 52-week highs. If it fails, we could see a rapid gap fill back down to the $37–38 range. The volume is the key. Yesterday's volume was enormous, a clear accumulation day. Today's volume, as high as it is more two-sided. This is why a simple self-investing approach of buy the good news can be tricky. The market is pricing that news and the next piece of news almost instantly. The earnings report itself highlighted the true drivers and the real risks. The growth story is multifaceted. The Asia-Pacific region was the star, with sales nearly doubling, up 94.2% reported. This is the growth engine. But the Americas, its biggest market, grew at a much more modest 10.3%, 21% constant currency. This was a point of concern for some analysts, like Jefferies, who recently reiterated an underperform rating. They are worried that the U.S. market is moderating and that competition from Decker's Hoka brand is intensifying. This is the expectation versus reality gap in action. The expectation is global dominance, but the reality is that its most important market is showing signs of maturation and intense competition. But the bulls have a powerful counterargument: apparel. ON's apparel sales, while still a small portion of the total, exploded by 86.9% to CHF 50.1 million. This is the secret weapon. If ON can successfully transition from just a footwear company to a full-blown performance lifestyle brand like Lululemon, the total addressable market expands exponentially. This is what growth-oriented Fidelity mutual funds are betting on. They see the margin expansion from DTC combined with the new growth vector of apparel as the formula for sustained earnings beats. UBS, for example, just raised their price target to $85, seeing a long-term compound annual growth rate of 20% or more. They believe the market is still underestimating this transition. For a moment, let's step back and define what this company actually does. On Holding is a Swiss company that designs and sells high-performance footwear and, increasingly, apparel. Its signature technology is cloud tech, those hollow pods on the outsole that are designed to provide a soft landing and an explosive takeoff. It started as a niche brand for runners and triathletes, but has masterfully crossed over into the lifestyle and fashion category, becoming a premium status symbol. Its business model is heavily focused on its DTC channel and a selective wholesale approach, avoiding the mass-market discounting that has hurt other brands. This premium positioning is core to its identity. This brings us to the future outlook. The company just raised their full-year guidance for the third time. They now expect constant currency sales growth of 34% for 2025, up from 31%. And a massive gross margin of 62.5%. This is the bull case in a nutshell. Continued market share gains, massive margin expansion, and a new growth story in apparel. The catalysts are continued strength in APAC, a successful expansion of their apparel line into training and tennis, and maintaining their premium brand image. But the risks are just as real. First, valuation. The stock is expensive, it is priced for perfection, and any stumble, a missed quarter, a dip in gross margin, will be severely punished. Second, competition. Hoka is also growing like a weed. Nike and Lululemon are not standing still. They're aggressively defending their turf and launching new, innovative products. Third, the macroeconomic picture. ON sells premium, expensive products. If the high-end consumer finally starts to feel the pinch from inflation or a slowing economy, that $200 running shoe is one of the first things to get cut from the budget. This isn't a stock for someone looking for low-risk investment help. It's a high-growth, high-volatility play. This is where your choice of broker matters. An investor using the Robinhood app or SoFi Invest might be focused on the brand momentum and buying fractional shares to build a position. A more advanced trader on Interactive Brokers trading platform would be analyzing the options chain, where we're seeing high implied volatility and setting complex conditional orders. Meanwhile, a long-term investor using a Fidelity brokerage account or looking at Fidelity ETFs is more focused on the 13F filings to see which major institutions, like FMR LLC and AllianceBernstein, are holding or adding to their positions. Speaking of institutions, 591 of them hold this stock, owning nearly 67% of the company, which shows significant long-term conviction. This is a true battleground stock, and the debate is fierce. It really comes down to whether you believe the expectation of it being the next Lululemon or the reality that it's a fantastic company in a brutal industry facing new challenges that come with its $13.7 billion market cap. I'm curious what you all think. comment below if you believe ON's biggest growth is still ahead or if you think the competition and valuation will stop its run. To wrap up, the $41.87 price we see today is the market's attempt to digest a truly explosive earnings report. The expectation was for a good quarter, but the reality was a blowout that confirmed the company's margin and growth story is fully intact. This has forced a major re-rating. But that same report also highlighted the moderated growth in the Americas, a reality check that the bears are clinging to. The easy part of ON's growth, being the new disruptive kid, is over. Now begins the hard part, executing as a major global player, defending against awakened giants, and justifying a premium valuation quarter after